I want to get to oil in just a bit, Jeff, but nearly $2 trillion in the value of options expiring today, and the markets seem pretty calm. What do you make of that?
You know, the markets are calm, Sully, but just like Motley Crue at Wrigley Field last weekend, today is going to kickstart your heart because you do have nearly $1 trillion in options rolling. And it is interesting to see the VIX. The VIX is under 30, therefore not really revealing a lot of paranoia or nervousness, to your point. But today is a really fascinating day because we've had 5 down days in the S&P 500. Here we are poised to potentially see what the consumer is going to do in retail sales, as well as consumer sentiment represented in the University of Michigan. Last month, Sully chalked up the lowest sentiment we saw. 50 was the number. And that's the expectation again this month. So it seems like the bar is quite low. And conversely, I still think the consumer is in some strength. But today's going to be a wild day, and you always see some type of pump fake when you see this options expiration.
All right, well, you're throwing out like Motley Crue songs. I'll see and raise you here. Once bitten, twice shy. Great white. I mean, people have gotten burned. They got burned last week by the market's head fake. What is going to be the catalyst for these markets going forward? Maybe not today, maybe not even next week, but what's going to be the turn, Jeff?
Well, I think you have to realize that we're in a normalization process. I don't see the deterioration process a lot of people are claiming when you hear the word recession. But what's interesting, we are seeing higher lows as we slowly inch forward here. We're seeing a lot of price discovery, if you will, as we're trying to really get a feel for what the Fed's going to do. But what's interesting, no one's talking about that the Fed has to be considering what type of rate cuts they're going to have in 2023. So they're going to be prudent. That's why I think we have to really understand this next move. 75 basis points is baked in, but I don't see that September rate hike. I know the CME group, Fed funds rate, is pricing that in. But what's interesting, in the wake of JP Morgan and Morgan Stanley yesterday, there's no news shock there, Sully. Look at JP Morgan. When the 10-year note goes from 1.5% to 3.5%, were you surprised that loan origination was down 45%? The one silver lining yesterday in JP Morgan, as well as Morgan Stanley, is that trading was up 17% and 21% respectively. So the catalyst is that you have to remember volatility makes markets go down, but also go up. So if we see earnings, yes, they are slowing. As long as we don't see earnings evaporating or disappearing, I think the market has the ability to go back up about 3 and 4%, retest that 50-day moving average.
You're an oil guy. We forget that. Where's oil going? That's how you started.
It is. And look at oil and copper. Copper is really interesting. Dr. Copper has kind of given us an idea of where the market is going. Yes, we just saw GDP almost go negative for the first time in a very long time over in China, but that's due to the lockdown. So lock and step, we have seen oil come back down, but I think oil goes back above $100 due to the fact that this global reopening, this demand, and we get some of these bears in the recessionary talk to fade a little bit as we see earnings seasons somewhat shine. So I see crude oil. I don't see demand walking away. We're going to see what President Biden and the administration can do from a supply perspective, but I do think the demand is still there. I think the consumer is strong. And it's nice to be here in Chicago, that a little bit of relief, a little bit of pain at the pump, which, don't forget, Sully, that pain at the pump has been one of the biggest drivers of inflation.